Hi guys, welcome to this Microsoft Excel. This is assignment tutorial 9, exploring financial tools and functions. We're going to be working on the case problem 1, which is on page EX590 and EX591. There are 17 steps to this. Alright, to get us started off, let's see what our objectives are for this particular wonderful assignment. Alright. Our objectives are going to be work with financial functions to analyze loans and investments. We're going to create an amortization schedule, calculate the conditional sum, interpolate and extrapolate a series of values, calculate the depreciation schedule, determine a payback period, calculate a net present value, calculate an internal rate of return, and trace a formula error to its source. Now, this is going to be the Microsoft Excel that probably is the most life usable for you guys that are going into accounting, business, that kind of stuff. If you ever plan on your own home or own business, loan and investment functions are going to be your bread and butter when using Microsoft Excel. Okay, the PMT function is going to be the first function we're going to be using. It's used to determine the size of payments made periodically to either repay a loan or reach the investment goal. The syntax of the PMT function is PMT, the rate, the NPER, the PV, FV equals 0, and type equals 0. The rate is the interest rate per period. The NPER is the total number of payments per period. PV is the present value of the loan or investment, and FV is the future value of the loan or investment after all the scheduled payments have been made. Let's see. The next we're going to be doing borrowing cost with the PMT function. To calculate a payment with a PMT function, we're going to use an optional type arguments whether payments are made at end, type 0, or beginning of each period. And an interest rate and payment periods must use the same time same time unit. Cash flow indicates the direction of money to and from an individual or a company. Positive cash flow represents money that's coming to the individual or received. Negative cash flow represents money that is leaving an individual or is being spent. So just think of it. If I'm getting money, I'm a very positive person. If I'm giving money away, I'm going to be a very negative person. So positive's in, negative is out. The PV argument for a loan is positive because it represents the amount of money being borrowed coming to the individual. The PMT function for a loan return is a negative value because it represents money being spent to repay the loan. So it's positive when someone gives me a big lump sum of money. It's negative when I have to give them money back for that big lump sum. The PV argument is negative when used with investments because it represents the initial amount of money being invested or spent. The PMT function returns a positive value when used with investment because it represents returns. So when I'm investing with a bank, I give them a bunch of my money, that's negative. When they give me money back because my investments have done well, that's a positive. The future value, or the FV function, we're going to always default to 0 for the future value when the intent to repay a loan completely. So if I have a house loan and I've done my amortization schedule, my future value is going to be 0 because I want to owe them nothing. When a loan will not be completely repaid, you can use the FV function to calculate the loan's future value. The syntax for the FV function is FV, rate, NPER, PMT, present value, type 0. When we're calculating borrowing costs, to calculate the payment period with the NPER function returns the number of payment periods, not necessarily the number of years. The syntax of the NPER function is NPER, rate, PMT, PV, FV0, type 0. Now what that means by payment periods, not necessarily the number of years. You may have 12 payment periods in a year if you pay a house once a month, which means your payment periods over the course of 10 years will be 120 payment periods. If you only pay this amount once a year, your payment periods may be equal to the same amount of years of the loan. That's not very often the case. To calculate the present value with the PV function, calculates the present value of a loan or investment. For a loan, the present value would be the size of the loan. So if I take out a loan for $10,000 for a car, my PV is going to be $10,000. For an investment, the present value is the amount of money initially placed in the investment. If I have $10,000 and I invest it into stocks, my PV is $10,000. For calculating borrowing cost, we're going to be using a PV function a lot. Now, an amortization schedule, always had trouble with this word, is an excellent tool. It tells you what you're going to be paying and owing over time, or what you'll be doing gaining over time. So if I'm using an amortization schedule on a mortgage, I have my present value, the amount that I borrowed, and the amortization schedule takes my payments into consideration until I'm at zero. If I'm doing an investment, my amortization will take my initial investment plus my returns over time to see until I can hit that goal that I'm wanting. The amortization schedule specifies how much of each loan payment is devoted towards interest and towards repaying the principal. Principal is the amount of the loan that is still unpaid. Calculating interest and principal payments. To calculate the amount of loan payment devoted to interest and principal, use the IPMT and PPMT functions. The IPMT function returns the amount of a particular payment that is used to pay the interest or loan. It has the syntax of IPMT, rate, per, in per, PV, FV, and type. The per argument defines the period for which you want to calculate the interest due. To calculate the interest and principal payments, the PPMT function calculates the amount used to repay the principal. The PPMT function has the following syntax: PPMT, rate, per, in per, PV, FV 0, type 0. Now, to create the amortization schedule, we're going to calculate the cumulative interest and principal payments. Cumulative meaning all together. Cumulative totals of interest and principal payments can be calculated using the CUM IPMT and CUM PRINC functions. Alright, the CMP IPMT function calculates the sum of several interest payments and has the syntax CUM IPMT, rate, in per, PV, start, end, and type. Start is the starting payment period for the interval you want to sum, and is the ending payment period. Calculating cumulative interest and principal payments. This function has no FV argument. The assumption is that loans are always completely repaid. You're never going to take out a loan and then just not pay the last $1,000 of it. You're going to pay it all down to zero. Note that the type argument is not optional. You must specify whether the payments were made at the start of the period, type 0, or at the end of the payment period, type 1. Alright, to create a amortization schedule, you can see the function and the syntax used inside this diagram. One of the big things we're going to be using in this assignment is projecting future income and expenses. Like I said, these workbooks we're going to be working with, this chapter, is all stuff that you'll be using in your day-to-day life if you own a business, own a home, or plan on working for any business or financial organizations. This is very basic accounting stuff. So we're going to be projecting future income and expenses. A key business report is the income statement, which is the one we're going to be working on. Also known as the profit and loss statement, which shows his business's income and expenses over a specific period of time. Income statements are often created monthly, semi-annually, or annually. Monthly, you get 12 of them. Semi-annually means you get 2 of them. Annually means you get 1 of them every year. Most income statements are divided into 3 main sections. The income section projects the income from sales as well as the cost of supplying those items. The expense section projects the general expenses incurred from operations, and the earnings section estimates the net profit and tax liability. So it's usually divided into the income section, the expense section, and projected sections. A linear trend, values change by a constant amount. A growth trend, values change by a constant percentage, and it appears as a curve. If you know the beginning value in a series where they constitute a linear growth trend, autofill can fill in the missing values. This is a great feature that just really came in the 2010-2013 office. Normally you had to do this by hand. Another part of the income statement is the cost of sales or the cost of goods sold. The difference between the sales revenue and the cost of goods sold is the gross profit. Gross profit is pre-tax profit. Net profit is post-tax profit. So the cost of doing business plus what you sold, or what you sold minus the cost of doing business, is your gross profit. I think that's enough of that. Let's get into the worksheet. We are on case problem 1. We're going to need the DAT files digital. So let's open that up. And as always, documentation is the first one. So let's go ahead and put our name and date into this. And this is 12/1/2014. Okay. And we know we're going to save it the next step. And I always work on my desktop, and we're going to save it as digital frames. Now, if you're paying it, I already got one open, so let's just change that to digital frames 1. If you're paying attention to the rubrics, you'll notice that you'll be turning in 3 worksheets for this. Digital frames 1, 2, and 3, I think. Digital frames 2, and digital frames 3 is the 3 things you're going to be turning into me. Alright, in the document worksheet, and rename the current date, done that, so we're on to step 3 already. Linda can upgrade the computer system by purchasing equipment for $18,000. She would also want to buy a 36-month service contract at the time of purchase for $540. Linda anticipates that she would be able to sell the system for $12,000 after 3 years. When will it be time for her next upgrade? Enter these values in the buy versus lease worksheet for the range B4 through B6. Notice we have the buy conditions. When did she buy it? The negative outgoing money. So her first initial purchase was $18,000. Alright, she would also want to buy a 36-month contract for $540. And Lisa anticipates that she'll be able to resell it for $12,000 after 3 years. So we've entered these through B4 through B6. Pretty easy step. Okay, we're on to step number 4. Under the lease option, Linda will be able to lease the equipment for $325 per month for the next 36 months. That's 3 years, guys. 36 months. She will also have to pay a $1,000 security deposit at the time of the purchase. She won't need to buy a service contract because the company provides service on the computer it leases. Enter the values in the buy versus lease worksheet in the cells B9 and B10. Okay, we know she's going to have to pay a $1,000 security deposit. And she's going to make monthly payments of $325. Alright, on step 5, in the range of E2 through F2, that's E2 through F2, enter the initial investment for each option. For the buy option, Linda will have to initially pay for the computer system and the service deposit. Under the lease option, Linda will have to initially pay for a security contract. And they gave us a nice hint here. Enter these initial expenditures as negative cash flow. So these are going to be negative numbers. So for her buy option, she's going to have to enter or pay out $18,540. For the lease option, she's going to have to pay out $1,000. So we're going to try to figure out what is the better option, leasing or buying. In the range of E3 through E8 for month 1 through month 36, enter 0 to indicate lender will not make monthly payments once she has the computer equipment. E3 through E38. E36, I'm sorry. So we want 0 on these. In range F3 through F38, enter the amount lender would have to spend under the lease option each month as a negative cash flow. So we're going to have a monthly payment of negative $325. In the range E39 and F39, E39, F39, enter formulas that reference the revenue Linda will earn from selling the computer systems under the buy options and the revenue she will receive under the lease option when her security deposit is returned. These values should be entered as a positive cash flow. So at the end of the contract, how much is she getting back? How much is she going to earn back? So in the buy option, she gets back $12,000, or at least she thinks she can sell it for that much. In the lease option, she will get her security deposit back, which is just $1,000. Okay, we're coming up on the step 9 in the cell B12. Enter the annual discount rate of 9.6%. In cell B14, enter a formula to calculate the monthly discount rate. Okay. The monthly discount rate is just going to be the annual discount rate divided by 12. So this is just going to equal B12 divided by 12. So each month she's going to get 0.8%. In cell B15, enter a formula to calculate the net present value of buying the computer system by adding the initial investment in cell E2 to the present value of the cash flows in the range E3 through E39. Use the MPV function with a monthly rate of cell B14 as the rate of return to calculate the ultimate cost of the computer system if Linda buys it. All right. So first we have our E2 number. So we have E2 plus the MPV value, and we're going to have the rate and the values here. My rate is B14. You can see the monthly discount right here. And then my range is going to be, rate B14. My range is going to be E3 through E39. Or E36. No, E39, yeah. Sorry. And make sure we close off. So it would cost her $9,604 to wind up buying option. Now for the lease option, we're going to do the same thing here. We're going to do F2 plus the MPV of B4. Oh, 1 second. Yes. Sorry, I had a little bit of cough there. All right, our rate is going to be B14 with the range of F3 through F39. Let me close off the parentheses. So if she buys it, she's only going to wind up spending out $9,604. If she leases it, she's going to wind up spending out $10,386. So for her, it would be a better option to buy the equipment up front. All right, next we're going to save this workbook. And then we're going to use a goal seek to determine the monthly payments from leasing that will cause the net present value of leasing to exactly match the net present value of buying. Hint, you must explicitly enter the net present value of the buy option in the goal seek dialog box. All right, guys. To do steps numbers 13 through 17, I had to make a little modification to the workbook. To do goal seek, we need everything referencing everything else. So what I have done is I've gone over here through F3 and F39, and I have set the formulas as equal, negative sign, and money symbol B10. So we're referencing over here to B10 as a negative. So then I've copied the formula all the way down through F38. So now to do the goal seek, I'm going to choose the lease option net value on cell A or B16. I'm going to come up to the what if analysis. I'm going to choose goal seek. I'm going to set cell B16 to value. Make sure you put negative 960403, and we're going to change it by changing the cell of the monthly payments and hit OK. Current value, hit OK. Now we can see to make the lease option equal to the buy option, we're going to have monthly payments at least down to $299.90. That we're going to save this as digital frames 2. And then we're going to go on to step 15. Return the monthly payments under leasing to its original value of $325. Okay, so with the new workbook, we need to make this $325. You can see it modifies all the way down. And Linda might not be able to sell the computer system for $12,000, so use goal seek to determine the resale value for the computer system after 36 months that will cause the net present value of the buying to be exactly the match the net present value of leasing. All right, so we're going to do a goal seek that changes the number of end of contract sale so that our buying option is equal to our leasing option. All right, to accomplish this goal, we're going to choose B15. We're going to do the what if analysis on the data tab, and we're going to choose goal seek. We're going to set cell B15 to the value of negative $10,386.35 by changing the resale value. Hit OK. And you can see we'd have to sell it for $10,949 to be the same value as the lease option. You can see that the resale value actually references down here to E39 as well. They are connected. All right, save this as digital frame 3, and you are completed with this assignment. All right, guys, that is case problem 1 for assignment 9 on page EX590 and EX591. If you have any questions, concerns, or problems with the goal seek, first thing, make sure you check your references. In a financial document, everything needs to reference everything else. That way, if you change one little number over here, the whole workbook flows and changes. Don't make the mistake that I did and let the Excel monster hit you where you just copy the numbers down. It seems like a shortcut, but it doesn't work. All right, guys, if you have any questions, email me, discussion board, or give me a phone call, or, of course, show up at my office. All right, good luck. Let me know.